Hello, finance bros and gals. Welcome to Financial Insight Weekly, your data-driven guide to the week that was and what it might mean for the week ahead. Today is Sunday, June 22nd, 2025. Each week, we dive deep into the numbers that move markets, aiming to cut through the noise and give you actionable insights. Now, for complete transparency regarding our data, we use programmatic data extraction to gather the information you'll hear, sourcing it from the Federal Reserve Economic Data, FRED, and Yahoo Finance. This gives us a consistent, broad look at everything from Treasury yields to equity performance and key economic indicators. Rest assured, the core analysis is built on that broad, automated foundation using the data available to us this week. All right, let's get into it. This week, we saw equities ease back, hinting at some caution, while inflation data continues its slow descent. GDP figures presented a mixed view, with a quarterly dip contrasting annual growth, raising questions about economic momentum. We'll explore these signals. Starting with equities, as of June 20th, the S&P 500 closed at 5967.84, down 1.28% for the week. It's still up 1.69% year-to-date, though it sits 2.92% off its 52-week high. The Nasdaq 100 also retreated, finishing at 21,626.39, a 1.31% weekly decline, but remains 3.1% positive year-to-date and 2.68% below its peak. The Russell 2000, representing small caps, saw a steeper fall of 1.44% to 2109.27. This index is now down 5.48% year-to-date and a notable 14.48% from its 52-week high. This underperformance of small caps often suggests a more cautious market sentiment, possibly a preference for the perceived stability of larger companies. This cautious mood is echoed by the VIX index, the market's fear gauge, which surged 14.43% week over week to 20.62. It's up 15% year-to-date, indicating rising expectations of market volatility, though not yet at alarm levels. On valuations, the SPDR S&P 500 ETF, SPY, carries a forward PE ratio of 25.69. This is on the higher side historically, suggesting significant optimism about future earnings growth or anticipation of lower interest rates. This valuation will need strong corporate performance to be sustained, especially given the current economic signals. Turning to interest rates, data as of June 18th showed nuanced movements. The short end of the Treasury curve was mixed. The 3-month yield eased 3 basis points to 4.42%. While the 6-month rose 2 basis points to 4.33%, and the 1-year also ticked up 2 basis points to 4.10%. The 2-year yield was unchanged at 3.94%. Further out, the 5-year yield fell 4 basis points to 3.98%, the 10-year yield decreased 3 basis points to 4.38%, and the 30-year yield also softened by 3 basis points to 4.88%. This resulted in a slight flattening of the yield curve, which can sometimes signal expectations of slowing economic growth. The 10-year minus 2-year Treasury spread, a key recession indicator, narrowed by 3 basis points to 0.44% as of June 21st. It's not inverted, but the narrowing trend is worth watching. Real yields, which adjust for inflation, declined. The 10-year real yield fell 7 basis points to 2.07%, and the 5-year real yield dropped 10 basis points to 1.62%. Lower real yields can make riskier assets more attractive or signal weaker economic growth expectations. Inflation expectations via 5-year and 10-year break-even rates edged slightly higher to 2.37% and 2.33% respectively, suggesting the market anticipates inflation to linger around these levels. For housing, the U.S. 30-year fixed mortgage rate eased slightly by 3 basis points to 6.81%. In credit markets, U.S. high-yield option-adjusted spreads tightened marginally by 1 basis point to 3.16%, indicating continued, if cautious, risk appetite. The labor market showed continued, albeit perhaps moderating strength. May's non-farm payrolls added 139,000 jobs, with year-over-year growth at 1.1%. The unemployment rate held at 4.2%, though this is up 5% from a year ago. Average hourly earnings rose 0.42% month-over-month and 3.87% year-over-year to $36.24. April's JOLTS job openings increased from March but were down 2.99% year-over-year. Collectively, this suggests a tight labor market that might be starting to cool. Inflation continues its gradual descent. The May CPI rose a modest 0.08% from April, with the annual rate at 2.38%. Core PCE, the Fed's preferred measure, increased 0.12% month-over-month in April, for an annual rate of 2.52%. These figures point to disinflation, but the pace remains a central focus. On economic growth, Q1 2025 nominal GDP was $29.98 trillion, up 0.85% quarter-over-quarter and 4.73% year-over-year. However, real GDP, adjusting for inflation, contracted by 0.06% quarter-over-quarter, though it remained up 2.06% year-over-year. This divergence suggests the economy might be navigating a soft patch. Consumer sentiment, via the University of Michigan survey, dropped sharply in April to 52.2, down 8.42% from March and 32.38% year-over-year. This pessimism contrasts with the relatively stable job numbers and could weigh on future spending. The U.S. trade balance for April showed a deficit of $61.6 billion, a significant 55.45% month-over-month improvement, which is a positive for GDP calculations. Quickly on liquidity, overnight reverse repo usage remains very low at $0.14 billion as of June 20th, indicating ample short-term funding. The Treasury General Account, TGA, stood at $0.34 billion as of June 18th, up slightly week over week, but down nearly 50% year over year. A lower TGA typically means more reserves in the banking system. Total public debt in Q1 2025 was $36.21 trillion. Absolute interest payments on this debt reached $1.114 trillion in Q1, up 4.4% year-over-year. While this absolute figure is large, as a percentage of GDP, interest payments are historically much lower, often around 3 to 4%. However, the rising absolute cost is a key aspect of fiscal health. This week's data paints a picture of an economy at a crossroads. Equities have pulled back slightly, with small caps showing more pronounced weakness, and market volatility has risen, hinting at some apprehension. This could be tied to the mixed economic signals. The labor market remains resilient, but shows early signs of cooling, while consumer sentiment has notably soured. Inflation is moderating, but the pace is gradual, keeping markets attentive to central bank policy. The Q1 real GDP showing a slight quarterly contraction despite positive year-over-year growth is a critical data point suggesting the economy might be losing some immediate momentum. The bond market appears to reflect this caution, with yields generally softer and the curve relatively flat. High equity valuations, particularly the S&P 500's PE ratio, suggest an expectation of robust earnings, which will be tested if economic activity indeed softens. The overarching question is whether this is a temporary breather or the start of a more significant slowdown. The current data offers clues, but no definitive answer, underscoring a period of heightened uncertainty and the need for careful monitoring. That's all for this edition of Financial Insight Weekly. Thanks for tuning in. Until next time, stay informed.